Hi, and good afternoon, everybody. I think we're now live. We're going to kick off this webinar. This is the Akoya webinar concerning our response to the CFPB's proposed rules, the ANPR under Section 1033, and what it means for the future of open finance in the United States. My name is Paul Horan. I'm the General Counsel here at Akoya. And I'm joined today by Courtney Robinson, who is our Head of Policy and Communications. We have a short program today in which we're going to walk through the points that Akoya made in our response to the CFPB this week. Before I do that, just lay a little bit of background information. Akoya is a connector in the open finance ecosystem. We focus on secure connections, allowing consumers to control who they share their data with. We connect over 4,600 financial institutions to thousands of fintechs and others. Our focus is on API-only connections, and we don't store data, we don't retain data, and so we're somewhat unique in that is our perspective on these things. We're going to talk about the 5 points that we made in our letter to the CFPB today. I'm going to describe what those 5 are, then I'm going to turn it over to Courtney to give a little more background. But the 5 points we're going to talk about in detail. Number 1, screen scraping and why screen scraping remains a systemic risk and should be banned in the rule. Number 2, our second position is that data providers should be able to charge reasonable access fees. Number 3, consent, consumer control, and secondary use limitations should continue to be part of the rule. Number 4, representative under the rule should be interpreted to include commercial third parties. And number 5, a framework for open banking under this rule should be implemented with urgency. So that's just a little sneak preview of the points we're going to talk about in detail. But first, I'm going to turn it over to Courtney to give a little more background about the ANPR process and where things stand.
All right. Thank you, Paul. So just setting the stage of where we are right now in the 1033 world. Section 1033 of the Dodd-Frank Act is one of 2 required rulemakings for the CFPB, and it concerns personal financial data rights. So the rights of the consumer to be able to take their own information and use it to control their financial lives. So there is a rule that was finalized in October of last year with compliance dates set to start next year. We are now in a space where, because of a new administration and because of litigation, there is a relook at 1033, and it is being revisited by the current administration, and they put out an advance notice of proposed rulemaking. So that advance notice of proposed rulemaking, in which the comment period ended 2 days ago, asked a series of questions about, I would say, things that were more unsettled in the rule, things that folks had questions about, and the new CFPB is taking that into consideration as they potentially write a new rule for 1033. So I would say that the stakes here are fairly high. The CFPB, under the last administration, had a great rule. We're glad to see that there was a rule, but there are definitely some things that could have been addressed in a better way to ensure protection for consumers and their data. And there is still an opportunity here to have a data sharing infrastructure that is shaped by API-based data sharing versus less secure measures like credential-based access for that information. And that's very important for financial institutions themselves, for data security reasons, and for customers for the very same reason. No oversharing, no providing information that's not needed. And I know Paul will go into that more, discussing representative and secondary use. But it is Akoya's perspective, as always, that open banking should be secure, permissioned, and sustainable. So customer is always at the forefront. The consumer's interest and data privacy and choice are always at the forefront. And again, we're talking about the Consumer Financial Protection Bureau and the Personal Financial Data Rights Rules. So it's tied into what is there. And the ANPR, we believe, is a chance for the CFPB to get right what they missed in the previous rulemaking. And we can potentially have a place where we have aligned everything around not only existing market structure and operational reality, but for something that is more protective of consumers, their data, and the integrity of the open finance ecosystem, which goes into screen scraping, Paul.
Great. Thanks, Courtney. And one thing I should note, we're going to talk about the 5 points in a little more detail that I mentioned up front. We do have time at the end for questions. So we'd ask that if folks have questions, there's a window you can put the questions in as we go. We'll cover all those at the end. So the first point that we made in our letter this week was regarding screen scraping. Straightforward, right? Screen scraping remains a systemic risk and should be banned outright. What do we mean when we talk about screen scraping? Courtney also talked about credential-based sharing, basically the same thing. This is where, in order to grant access, consumers are asked to provide their online banking credentials to a third party, which then logs in as if they're the customer and literally scrapes the data off the screen. And that's sort of historically how a lot of data sharing was done. There's been a big move in the industry, even before the rule, to move towards API-based connections. And of course, Akoya supports that. Akoya is an API-only network. We've never screen scraped and we don't collect credentials. What the rule didn't do, the rule mandated that banks build developer interfaces that are API-based. That's good. What it didn't do was take the next step, which is to say that once the developer interfaces are built and accessible, third parties can no longer use screen scraping to access data. That was what we view that as the biggest miss in the rule that was promulgated last year. Because as long as it allows that backdoor for access through screen scraping, there's just inherent insecurity in the system. You're going to continue to have consumers sharing their login credentials. You're going to continue to have third parties collecting big sets of login credentials that are then vulnerable to a breach. And absent a ban on screen scraping, what the rule does is it creates an obligation on the part of data providers to build the interfaces while giving options to third parties to either use the developer interface or to continue to screen scrape. So we think this is actually a fairly simple change that the CFPB can make in the rule. Just say that once developer interfaces are built and available, that's the exclusive way that data can be shared, and third parties looking to share data from that financial institution are no longer allowed to screen scrape. It would be important to place this obligation on the third parties rather than to try to put the obligation onto banks to force them to block screen scraping. Banks are allowed to block screen scraping, but really the obligation ought to be on the third parties to stop screen scraping and to delete credentials once that API connection is available to them. Secure APIs obviously are one of the keys to protecting consumers. They also are a sustainable way to promote data sharing. And when we talk about sustainability, we start to talk about the economics of it too. And that turns us to our next topic, which is access fees. And I'll turn back to Courtney for that.
Right. So in our comment letter, we took the position that financial institutions should be able to charge fair, transparent, and reasonable fees to sustain secure infrastructure and improve open banking without harming competition. Because that is, like Paul said, a big issue. The economics in having to invest in that type of infrastructure upfront, but having to then proffer the consumer information or data at no cost hurts financial institutions, especially when we're talking about, we're not speaking of the giant, huge financial institutions who have been working on this for years. This is also an issue, since we're talking about compliance and competition for financial institutions of all sizes, being able to recoup some of that infrastructure cost. And it also encourages, we believe, continued innovation. We have seen ourselves through our work at Akoya that building and maintaining a secure API interface costs millions of dollars for institutions, and there are ongoing costs with security, maintenance, risk management, et cetera. And third parties who access consumer information and permission data benefit from all of that upfront investment and compliance and regulation without having to put in those economic resources. So we believe that a balanced fee framework would promote continued innovation and consumer protection while also allowing the customers of institutions, small and medium-sized institutions, credit unions, community banks, et cetera, to be able to serve their customers in the same way and allow them to be a part of this open ecosystem and open finance. And it really is just a matter of competition, safety, and again, reasonableness. So the takeaway from that, I would say, is that the CFPB has the ability to both enable competition and sustainability if they define what reasonableness is, what is a reasonable fee or framework, instead of an alternative of something like fixed pricing gaps or something that puts the regulator or government's hand too far into the market and competition. So there is a balance there that promotes, we believe, both competition, more people in the ecosystem, infrastructure, and then also the ability of data providers to be able to offer this service or bring open banking into their ecosystem. So I will now go back to Paul again to discuss privacy, consent, and data usage.
Sure. Thanks, Courtney. So the next, one of the topics that the CFPB asked about in their invitation for comments through this ANPR, well, two of the topics really were security and privacy. Should any of the security and privacy provisions in the rule that they issued last year be changed or altered? And we think sort of fundamentally, most of those provisions should remain, particularly around consumer consent, control, secondary use. So a couple of specifics there. First of all, on consent enhancements, we think that the rule can be clearer in requiring that the consent that the third parties collect from consumers should disclose the frequency, duration, and scope of data access. This is sort of inherent in the rule, but maybe not made explicit, and we think it should be explicit in the rule because that kind of information is key for consumers when they decide whether they want to share data. Sometimes consumers will think, oh, I want to share data just for a use case that's a one-time use only. And if that's the case, the disclosure one-time data collection only. And it, on the other hand, other data sharing is daily or even multiple times a day. That can be okay as long as the consumer understands that that's what's going on. And the only way to promote that consumer understanding is by requiring it to be part of the disclosure that a third party gives to the consumer when they're signing up for the product or service. So giving real-time visibility and sort of granular information about that is important. Second point is around data control mechanisms and revocation mechanisms. So again, the rule did provide that data providers, as well as third parties, can provide a means for consumers to revoke their consent so that when they want data sharing to stop, they can do it easily. That's really important. We think it actually could be improved a little bit, the rule that is, by making explicit that the revocation can be, it need not be an all or nothing thing. There's at least one way to interpret the rule as it's now written is that the data provider can allow the consumer to revoke consent, but It's either all or nothing. They're either doing it for all their accounts or none of their accounts. And we think revocation can actually be more nuanced than that, and that a consumer who might be sharing data across multiple accounts maybe wants to stop sharing data for one or two accounts, but continue for another. Data providers, financial institutions, ought to have flexibility in how they design their revocation mechanisms to give the consumer more control. Because at the end of the day, that's really what this should be about, is consumer control and consumer transparency. And then the third specific point, and maybe the most important one, is the limitations on secondary use. So the rule provided that the third party in collecting data should only collect data that's reasonably necessary to provide the product or service that the consumer is signing up for. And the data should not be used for other purposes. Other purposes can be a lot of things, like product enhancements, marketing, even fraud, anti-fraud controls, a whole host of things that would fall under secondary uses that are not really for what the consumer is signing up for, but rather in what the third party, the fintech app, is interested in. We were very supportive of the rules, fairly tight limitations around secondary use. Really, this whole data sharing should be about enabling consumers to get the products and services they want. It's really not for the benefit of the third parties that are collecting the data. So limiting their ability to use the data, we're very supportive of, and we think that ought to continue. It's really all about trust and transparency at the end of the day, and making sure that consumers understand what's happening with their data. And we think all of these provisions are important to keep in the rule and even enhance in a modified rule. And this is very much related to the next point, which is around the definition of representative under the rule. This is a little bit of a legal point. Now, I'll try not to get too far in the weeds on the legalities of it, but the issue here is what does the statute mean when they talk about a consumer's representative? So why are we even talking about this? The statute says that, the 1033 says that financial institutions have to make data available to their consumers. Other parts of the Dodd-Frank Act define consumers to mean the agent, trustee, or representative acting on behalf of the consumer. So that's why fintech apps can sort of rely on 1033 in getting access, because they claim that they are the representative of the consumer. And that's really, candidly, how this entire ecosystem has developed over the years. However, there was a litigation brought to challenge the rule. It was brought by the BPI and others. And one of their arguments in the litigation was that that's not the proper reading of representative. A representative should really only be someone who has fiduciary duties to the consumer. And a commercial third party, like a fintech app, doesn't qualify. Therefore, fintech apps and other financial institutions are not consumers under the rule. So that litigation still is out there, but it's been paused while the CFPB modifies the rule. And so one of the things the CFPB asked about in this ANPR is, how should we interpret representatives? Should commercial third parties be included as a representative acting on behalf of the consumer for purposes of this rule? And Akoya takes the position, yes, it should. I mean, really, that's the entire premise, frankly, of open finance or open banking, is that the commercial third parties, fintech apps, or other banks that are providing services to consumers, consumer wants to share data with them, they are acting on behalf of the consumer when they collect the data, and so it ought to be covered by the rule. That makes sense to us. However, an important caveat to this point is that that really only applies as long as the fintech app is truly acting on behalf of the consumer. That calls back to this secondary use point, right? When the fintech app starts using the data not for the consumer's purpose, not for the product or service that the consumer signed up for, but rather for some other use, some secondary use, they're no longer a representative acting on behalf of the consumer. They're now acting outside the parameters of the rule. So really, this is an area where, in our view, that like a lot of things in this space, that there's a lot of linkage between these points. And yes, a fintech app or another commercial third party can be a consumer's representative, but only when they're acting on behalf of the consumer. And that ties back to what data they're collecting and how they're using the data once they have it. So we think as long as the secondary use provision stays in place, then commercial third parties should be considered consumers' representatives acting on their behalf for purposes of the rule. And so that gets us back to sort of our last point. I'm going to turn it back to Courtney to talk about timing. Time is always of the essence. So Courtney, why don't you help us understand why?
Time is always of the essence. So one of our major arguments and one of the things that we are standing behind is that a regulatory framework for open banking should be implemented with urgency. Most large financial institutions have already prepared for complying with 1033 or the rulemaking. They've been prepared for implementation for some time, and delaying or not having deadlines, pushing back deadlines only benefits bad actors and those who, like we discussed, are utilizing things like screen scraping and other anachronistic practices that make consumers' data unsafe. And we at Akoya know, because of our work helping financial institutions deliver solutions or create open banking, open finance solutions and compliant products, that the deadlines that are in the rule as it is are reasonable and achievable. So we encourage the Bureau to balance flexibility with urgency, because every day that there is no mandate or that there is no regulatory framework in place is another day that consumer data is at risk. And that goes back to another point from the original or the personal financial data rights rulemaking that we have in place now. When we're talking about liability or consumer data breaches or things like that, these things were to happen as financial institutions or data providers, those are your customers at risk, and those are issues that everyone in the ecosystem has to work through. And we know data breaches happen quite often at high cost to financial institutions themselves. When we're talking about going with an API-based, no screen scraping framework with deadlines in place for that compliance, once institutions have set up their developer interfaces, it's not a large step to say, just go. Because at the end of it all, this is about consumers, their rights to choose how their financial data is used and to make sure that that data is secure and safe. So every moment that there is no regulation or that it's not in place is another moment that something could happen. So with that being said, we are going to transition to Q&A. And if you all have questions, please just continue to add them in the Q&A section of the frame, and you might have to scroll down a bit to get to it, depending on the size of your screen, to see where to enter a question. But please continue to do so and add to what we have now. So let me go myself and scroll there. So one of the questions we have is, what role should financial institutions play in enforcing API-only standards? And Paul, I don't know if you want to take a crack at that first, or I can have thoughts.
Sure. I mean, I think there's a couple of points on this. First of all, over time, a lot of financial institutions have set up API connections and have encouraged or required, really, third parties to access data only through those API connections. I think the rule contemplates that that's basically the structure that they see going forward, that and there'll be a compliance timeline, as Courtney was mentioning, but based on where a financial institution is on that timeline, they will have to develop this API standard that everyone will be required to use. That gets us into the question of whether, when we talk about an API only standard, what happens with screen scraping? Again, the rule as it's now been issued, I think takes the view that screen scraping the market will just naturally move towards API connections, and screen scraping will go away on its own. We take a contrary view to that. We think that really it needs the regulatory push to get people off of screen scraping. I think one thing that financial institutions, wherever the rule lands on this point, I think financial institutions are going to be asking the question, well, what can I do? I've set up this API. What can I now do to block screen scraping? Contractually, I can require people to come through to the API. There are also technical ways to try to block or frustrate screen scraping, none of which are perfect, but all of which, the more friction there is in screen scraping, the more it pushes the scrapers to use the API. So as financial institutions think about moving to being API only, blocking screen scraping is something that probably will be on folks' agenda, I would think.
That's exactly what I was thinking as well. It's in the benefit and interest of financial institutions to advocate for an API only standard for the safety and security of their customers, as we just discussed. And screen scraping, again, no reason for it to still be there. Even with smaller financial institutions, there are ways through like Akoya to get past that challenge and make it so you can have your customers' information transmitted securely with no personal information attached. Let me go through and move to the next question. Let me see. Where do you see opportunities for industry-led collaboration post-rulemaking? Do you have any thoughts, Paul? Okay.
Well, one thing I think that is a couple of unknowns. One of the big unknowns is sort of risk management standards and how financial institutions are going to approach their risk assessments of third parties who are looking to access data. So just to step back, an authorized third party can come and request access to a developer interface. The bank essentially has to allow that authorized third party to access data, but only if the financial institution is satisfied that the authorized third party meets risk management criteria. However, the rule doesn't define what the risk management criteria are, or what they need to be. Obviously, there's existing prudential guidance on risk management and third-party assessments. But all of that, I think, has to evolve, and I think it likely is likely to evolve through maybe through organizations like FTX or others. But I think you're going to see some additional clarity on that third-party risk management over time.
Thank you, Paul. I think there's another question that we received that I think is a good segue from that one. So I'm just going to jump to that.
Sure.
Where does Akoya's positioning differ from other industry groups like BPI or FTX?
Yeah, I think the main one is probably on the representative point that we talked about. I mean, BPI, so that's, again, in bringing the litigation, that was one of BPI's main arguments, that the rule essentially trying to strike the rule because the definition of representative didn't include commercial third parties. I understand why BPI took that position. We don't share that view. We take the view, as I mentioned, that commercial third parties can be representatives, assuming they are in fact acting on behalf of the consumer. including by meeting all of the requirements around consumer consent, protection, and so on and so forth, secondary data use. So that's probably the number one area where we've been taking a somewhat different position than at least BPI. I think on everything else, we're basically aligned on fees, on screen scraping, and on the obligations to, deliver for third parties to deliver clear disclosures around what kind of data they're collecting, how often, and that sort of thing. So that's probably the number one difference in terms of our different positions.
Thank you.
I'm trying to think if there are other good examples, particularly with FTX, but
yeah,
that's the primary one, I think, that we have a somewhat different view from BPI.
You had I would say more of a comment versus a question, but I do want to acknowledge it, about the compliance deadlines and the readiness of financial institutions to comply. Once, if you're working with Akoya right now or hoping to work with Akoya in the future, as we hope to work with you as a partner, the process of setting things up, we can do that, but it's we understand it's institution by institution, and we want to make sure that we have everything right for everyone. So again, urgency, deadlines, compliance, but doing it right, and do acknowledge that it does take time to get these things done, for no matter the size of your financial institution. So without saying everybody is ready for the race, we do want to acknowledge that comment for those of you who are working with Akoya.
Yeah, and Courtney, I'd add to that, if I can jump in for a second. I mean, no, as much as we think that there ought to be this area is ripe for moving quickly, we recognize that not everybody is similarly situated, and the rule has a tiered compliance deadlines. I mean, we're basically supportive of that structure. Now, what the tiers specifically are and how long the different tiers are going to have, that's certainly a conversation that's worth having, and I think different people might have different views. But the notion of that, I completely agree with the commenter that, yeah, the biggest banks are much further along and are more or less ready, and the more medium-sized and smaller banks need more time. We completely agree with that, and I think the CFPB continues to think that way too. And I won't make predictions, but I'd be a little surprised if it didn't continue to be at least some tiering of compliance deadlines, and that the smallest financial institutions in particular are going to be given appropriate latitude to figure out whether and how they need to comply with this rule. There was in the original rule, there was a carve out for the smallest financial institutions, and whether or not that continues, I suspect it probably will. And even if it didn't, I'm sure those smaller places are going to be given appropriately much more time to comply with this rule.
Thank you. And so I'm scrolling through another related question that I think fits well with your comments. What support does Akoya provide for smaller or regional banks with limited resources?
Yeah, well, I can take a stab at that, Courtney, although you might be even better situated than me. Look, we work with financial institutions of all sizes, some of which have done a lot of work in this space and have a lot of the technology set up, and many of which that don't and are really sort of starting from scratch. So a lot of flexibility on our side to work with financial institutions regardless of their size. But Courtney, like I said, you probably can talk about it better than I can.
I think, we have an understanding at Akoya in working through or working with institutions of all sizes, again, that everyone is not similarly situated when it comes to financial resources, time, human resources to be able to do these things. So we can work with institutions to tailor the any open finance solution to what you need. If you need a full-fledged open finance solution to help you get into the world of open banking and API-based data sharing, also setting your institution up as a data provider. And I'll add, interestingly, as a conversation that we had earlier this week with a mid-sized bank, banks as data recipients as well. So, there's a lot of reliance on not internal systems, but things like core providers and to set up infrastructure, set up spaces, and do things like that. But Akoya is prepared to tailor and moderate to whatever is needed. So it's not just being able to provide the solution, but it's an understanding of what financial institutions of different sizes rely on to be able to serve their customers, and being able to help plug in there and enhance the services they're already offering.
Maybe I'll take a turn to read a question off here, Courtney, because I'm looking at them as well. There's a question on here about does Akoya foresee challenges with ongoing CFPB supervision or audit requirements? Which, look, it's impossible to talk about all of this without talking about sort of the status of the CFPB and the future of the CFPB. So that's an awfully broad topic. I don't know if we have time to get into all of that, but Courtney, what's your view on sort of this rulemaking is going on now? We're going to have a final rule, at some point. Then what with the future of the CFPB?
I know, so many things have changed in the regulatory space over the past several months, and I mean, even from administration to presidential administration on the just general policy front, the way that enforcement, supervision, and audit are approached by the federal financial agencies, including the CFPB. It's a bit of a crystal ball to say for foreseeing any challenges. I would say it just depends on what the final rule looks like, what it ends up being, and then what resources the agency itself has in place to continue to do the supervision, enforcement, and oversight. But from what we have seen and heard, 1033 and the personal financial data rights rule are very important and top of mind for this administration. And I'll actually note that the rulemaking started under the first Trump administration, then went into the Biden administration and director, and then now is back. So, I mean, challenges, it's just, typical turnover, implementation, those types of things. But supervision and audit are, core responsibilities of the CFPB and other agencies. So no matter what that ends up looking like under the CFPB, I do believe that those things will be there and should be considered when you're thinking about how to approach this rulemaking.
Yeah, that all makes a lot of sense, Courtney. A follow-up question or related question, I think on a lot of people's minds, is around timing here. The comment period on the ANPR just closed this week. I think I saw, you'll keep me honest, that it's like they got 13,000 or 14,000 comments, something like that. So a lot to wade through. A lot of those are kind of, forum comments or something, but they got dozens or maybe hundreds of substantive comments. What do you think we can expect? I'm not asking you for a predicted date or anything, but what is the CFPB moving quickly here, or do you think they're going to move slowly? What do you expect to happen?
Again, so just based off of what we have seen, I expect the CFPB to move quickly. They had previously stated through the both interim director, Russell Vaught, and then the head of Office of Management and Budget, Mike Calabria, and generally the folks that work on this alongside the administration, stated that they were going to move with expediency and reevaluating the rule, and that proved to be true. Within a couple of months, we got an advance notice of proposed rulemaking after they had stated that they were going to look at it, and that actually, shows how quickly they can work, even with a slimmed down workforce. I think on the folks that work on this, acknowledging that, but they have consistently said that they intend to move quickly, and because because they have with this ANPR, I guess I tend to believe that they will continue to do so when it comes to the next steps, like the proposed rule and then a final rulemaking. Paul, like you said, there are 13, 14 something odd comments in there, and they will go through and evaluate them all on the merits and then what positioning people take and what they have to say. But where I think, maybe in a previous life, I would have said, who knows how long this will take. I see that they under here, and particularly with this rulemaking, since it's something that we have information about, has been discussed, different groups have put input. We know priorities. Like I do expect them to move quickly, as they said that they would have.
So a revised final rule in 2026, do you think is a reasonable expectation? No guarantees, obviously.
I do. For first, I had to say, I was like, when is 2026? That's next year. But what year is it? But no, I do think that that's reasonable. I mean, we're in October right now, and we have an ANPR, Advance Notice of Proposed Rulemaking. That comment period is already closed. They're already starting to look through the comments that have been received. And so with the time we have left in this year, going into next year, also knowing that it is not being super wonky here, policy wonk, but that it's not an election year that turns over the federal administration, and these same folks will still be working on it. I think 2026 for rule implementation is quite reasonable and foreseeable. So
a lot to look forward to here in the upcoming weeks and months, sounds like, in this space.
Yes. Open finance is an important topic, important for consumers. That has also turned into a hot topic with the various interests of folks involved. But again, as a consumer first, it is very important to note that safety and security are paramount, and being able to offer solutions to your customers that put their information and their needs at a high tier, and also allow you to compete and comply and innovate are very important. So, and if you're not already working with Akoya, please do. Feel free to reach out to myself, Courtney Robinson, Paul Horan here, or Ted Anastasi, who is on our growth team, if you have any questions. And this webinar, because it was recorded, will be emailed out on demand. So again, if you have any additional questions, anything you didn't think of while you were here, or you go back and have something else, just please, we're all available to you. Thank you again for your time. We appreciate you joining us here, and we will wrap.
Thanks, everybody. Thanks for joining today.